Good afternoon. My name is Joe Litchow of Kepler Trust Intelligence, and welcome to our final webinar of this week's theme, Bounce Maybe Bounce. Over the week, we've had presenting fund managers discussing different sectors that have been substantially sold down in recent years, but hold the potential to bounce back if the tide turns. And today we'll be covering the UK, and it's a presentation that I'm quite excited about as we're joined by Sue Nofka, a bit of a veteran in the space. So Sue is the lead portfolio manager of Schroder Income Growth, which sits in the UK equity income sector, and she's also the head of UK equities at Schroders. Given Sue's experience, coupled with the resources at Schroders, she can fish across the whole of the UK market, including parts that aren't perhaps as common in the more traditional equity income portfolios. And she focuses on providing a real growth for investors, and by that I mean exceeding the rate of inflation and achieving capital growth as a result of that rising income. So for those not familiar with our format, we will be shortly hearing Sue present on the trust around about half an hour or so, and then we'll move on to Q&A, which will take up roughly for 10-15 minutes at the end of the presentation. So if you have any questions for Sue that you want me to put forward, just pop them in the Q&A box in the bottom right-hand side of your screen, and we'll get to them at the end. So with that, it's my absolute pleasure, Sue, to welcome you. Please take it away.
Thank you very much. Well, this is Themes for Your ISA 2024, and I love the bounce baby bounce. If we have a look at why I think there are 6 key reasons to consider or reconsider UK equities as the potential for your ISA in 2024. Joe, if you can put up the presentation, that would be fantastic. There we go. So the 6 reasons, some of those Joe has covered, that UK equity has been out of favour with investors. It is trading at a discount to global and particularly US equities. That goes across just about all except one industry on a price earnings forward 12-month multiple basis. And within UK equities, I think there is a fantastic opportunity, particularly in that small and mid-sized area, which has demonstrated a really fantastic long-term track record of performance, keeping pace with the best of global equities over a 25-year period, but where the last 3 years underperformance is really giving an opportunity today. Who's buying? Well, we've seen almost a bid a day this week and a lot of M&A activity, particularly at that small and mid-sized area from both private equity investors and international companies. They are snapping up bargains. What does the UK equity market offer for an income investor? A fantastic 4% plus yield, in addition to further capital returns through a pickup significantly in the last couple of years in share buybacks. So that's a total shareholder yield of some 6%. And of course, that was budget week this week, and we've had the opportunity to think about the creation of an additional ISA, so an additional tax wrapper for British investments, which was announced. There's a consultation period for the next 3 months, so we'll find out in June what can go in to that additional £5,000. Joe, you introduced me very nicely. I'd like to show everyone who my partner in crime is. So it's not just me who runs the trust. I'm joined by Matt Benison, who's an experienced investor with me. We've worked together for the last 8 years or so, and he's got 11 years investment experience. I've got a fantastic team back at base. So I manage money within a prime team. There are 5 of us. One's going to retire, and the 4 of us that are going to remain have got 16 years on average investment experience in the UK equity market. If we look at the trust itself on the next page, Joe, the objectives are twofold. They're both increasing income in real terms ahead of inflation and increasing capital growth. And both benefit from consistency and the power of compounding. On the income side, we are a dividend hero, and we've increased the dividend consistently in each of the last 28 years. We rely on our deep investment experience and really look at delivering capital returns through stock picking. And we've got a successful track record of doing that right the way across the market cap spectrum. So not just in the mega caps that are income rich, but we combine those positions with positions further down the market cap spectrum, which really deliver the growth in income ahead of inflation over time. So we can have a look at some key statistics for the trust. Just over £200 million in terms of net assets. So the shares are trading at a discount to the net asset value. All these statistics are taken at the end of last calendar year. The discount then was some 6.5%. The discount today is closer to 12%. We have a focused fund of between 35 and 50 holdings, currently 44, an ongoing charge of below 1%, and a current dividend yield, again at the end of December, of close to 5, just under 5. Today, with that wider discount, the shares are yielding some 5.3%. And we are targeting an income of the portfolio of about 110 or so % above the all share index. At the end of the calendar year, that was 113%. So not too high, because we want to deliver that consistent growth ahead of inflation, but enough to deliver a good level of premium yield to our investors. We take advantage of many of the levers that investment trusts offer investors. So we have gearing in the trust that, as Joe reminded me when we had our conversation earlier this year, magnifies the upside, but can magnify the downside as well. We've got 14% gearing in the fund at the moment, so enough, if we're right about the attractions of the UK equity market, that will boost returns if we see good growth. We have a maximum potential of 25% gearing. And again, we see most attractions from a valuation and prospects point of view in terms of income from the UK equity market. So although we are allowed to go fish in overseas assets, we currently have all our assets in UK equities. Let's look at the longer term track record of the trust. Here we show in green the share price return, in blue the net asset value return against that benchmark of the all share index. And we're taking the point at which I took control of the trust, so July 2011 through to the end of December 2023. And we have delivered returns at an asset value level, importantly, to shareholders through the share price, and these are all total returns. So good long-term track record. We'll flick through the compliance slides, which I think are the next 3 pages, Joe. We can come back to any of those if people are interested, and just pause on the calendar year, which was 2023, where in absolute terms, a reasonable return of 6.2%, but that was below the benchmark index return of some 7.9% for the year. And disappointingly, the share price return was below, it was actually negative, about 3%, as the shares moved from a premium to net asset value to a discount of some 6.5%. So we'll go through why the the trust underperformed the index in the next couple of slides. Here we look at the sector contribution. Green is good, red is bad. You can see that there are more significant bars at the red level than there were at the green level. So the detractors were in three sectors of industrials, basic materials, and utilities. That was principally stock selection, but there was also a size bias, so being overweight the mid and small sized area of the market, which lagged the returns from the largest companies. It's been a global phenomenon over the last year and a half or so, has been a detractor. We did have some successes, principally in the consumer staples area, where we were underweight a number of the large cap stocks that lagged the index, and stock selection within financials was a positive. Let's have a look at the next page where we can get a sense of which stocks were contributing or detracting from returns. And here we can see Anglo American, a materials company and mining company exposed to diamonds and platinum group metals, which really did suffer in a weaker economic environment. We also had exposure to luxury names, which survived the COVID period very strongly, but in the reopening phase, particularly for China, have underwhelmed, and Burberry has been caught up with that. Power companies such as Drax were weaker in 2023 than they had been in 2024, with power prices and also an overhang of government policy on biomass and energy security coming from that, weighing on the share price. And some disappointments from insurance company Direct Line, which had profit warnings during that period, and which we chose to sell out of. I know I'm going to get some questions on the M&A that's come through from a European insurance company there. And we missed out on the very sharp bounce coming from aerospace and defense company, Rolls-Royce. We were surprised by the extent to which they were able to renegotiate their contracts with the airlines customers, who did see a very strong bounce back from the COVID period. I'm sure there'll be questions and we'll come back to that, but in the interest of time, I want to get on to the market for income and how we manage the portfolio for that. This is a page taken from Computershare, which shows the attractions of the UK stock market for income investors. And even though gilts and cash, with the rise in interest rates, have risen up the competition for investors' money in the last 12 to 18 months, the UK equity market still stands out as a very good opportunity for income. And of course, I'm looking as an equity investor for income today, but also growth in income tomorrow, which you don't get from gilts and cash. If we have a look at what the track record has been for UK equity income, this is the market as a whole, and it's split in terms of the blue bars being regular dividends and the purple bars on top, that's the icing on the cake, being special dividends. Well, on an underlying basis, UK dividends growing at almost 5.5% in 2023, I think was a good result. But when you take total dividends into account, including those volatile special dividends, it's actually more pedestrian, because special dividends have fallen in each of the last 3 years from extremely high levels. And also cyclical mining dividends were lower, particularly they were large payers of special dividends. Now, Computershare have aggregated their outlook as having a growth of 2% on an underlying basis, excluding those volatile special dividends for 2024. Maybe we can turn to the next page and just look at how underlying shareholder returns are composed, because shareholders are not just receiving those regular and special dividends, they have also been receiving a large return of capital through the form of share buybacks. And that in aggregate amounts to some 6%. So very substantial returns to shareholders investing in UK equities. And when we think about the mechanism for share buybacks, which reduce the number of shares in issue and effectively give the resulting shareholders a greater proportion of both earnings and income through dividend income, that if we adjust for that, Computershare would suggest that last year dividend growth from the market as a whole would have been closer to 7% rather than the 5.5%. So almost 1.5 to 2% additional growth. I think that's a pretty attractive performance and return. One of my colleagues today had a look at my presentation and said, well, if you can compound that 7% or so dividend income and assume even flat capital returns over a decade, you'd be doing very well as an investor in terms of total returns. We're looking back at the trust itself. This is why we have AIC dividend hero status. We have an unbroken 28-year record of always increasing our dividend to shareholders. This track record equates to annualized dividend growth of 4.2% per annum between launch of 1996 and 2023, and that compares to an inflation rate of 2.3% per annum, CPI. So we're getting real terms growth in dividends of close to 2% per annum over 28 years. And when we compound up that, you get to something that is almost 70% higher than if dividends had just managed to match the level of CPI inflation. If we turn to the next page, this is a 10-year track record of the trust's growth. So rather than 2% per annum outperformance of CPI, because we've seen a more inflationary environment in the last 2 years, the extent of outperformance is narrowed to just under 1% per annum. And in 2023 fund year, so this is to the end of August, dividend growth was 4.5% for the fund, against CPI inflation around 2%, just over 2% higher than that. So we failed to match inflation in the year. We failed to match inflation over a 5-year period when inflation rates have been higher, but we have met our objectives of dividend growth in real terms over 10 years and over the life of the trust. Now, other features of investment trusts are interesting. So we don't have to pay out all of the dividend in any annual period. We can keep up to 15% of income in reserves, which means that we can mend the roof while the sun is shining in order to be able to continue to pay investors higher dividends when market environments are more challenging. And in the life of the trust, there have been some challenging periods. I would call out the COVID pandemic and the global financial crisis as key headwinds for income investors. And what has happened, if we have a look at the following page, is being able to retain some income has given us very strong revenue reserves, particularly coming out of the global financial crisis and pre the COVID pandemic. We had in 2019 equivalent revenue reserves to a whole year's dividend. And we've utilized those in the pandemic period to continue to increase dividends. And we have still strong revenue reserves of around 7 months to be able to continue to give investors confidence that we have the ability to maintain dividend growth for the trust into the future. If we have a look on page 20, I'd like to focus now on what our approach is to income generation. We have a differentiated approach to some other managers in that we take our responsibilities to generate an attractive total return, both in income and capital growth terms, for investors. And so we have about 3 buckets that we're looking for stock selection. Of course, we have higher yield companies that provide the bedrock of income for our shareholder dividends. And you can see those in the barbell to the right-hand side. They're utilities companies, they're banks, and other perhaps more distressed situations that we've done a lot of work on that we think can maintain and grow modestly their shareholder distributions. So that accounts for about a third by assets of the fund, probably more in terms of income for the fund. The other end of the scale, we've got a lot of companies that we've done work that we're really excited about their potential for growth in earnings, growth sometimes in the payout ratio, becoming more cash generative. And they're the ones that can power the fund's overall income generation to be able to deliver above inflation increases. And there's a whole range of companies from large, Onzil and Convatec and Relics are within the FTSE 100 to mid-sized companies. And they usually have really strong positions within their particular sectors, the industry champions, and we think they can be long-term success stories. And in the middle, we've got average yielding, but in our view, more exciting dividend growers from a whole range of companies, from banks, consumer companies, some utilities, pharmaceuticals, and some consumer names, Pets at Home and Hollywood Bowl and Unilever. So I'm sure there will be questions on holdings, and we can come back to some of those pages. I wanted to give you a flavour of what I've been doing within the trust in terms of activity over the 12 months to December 2023. And these are all completely new names under the green new additions and complete sales under the purple bar. A sense of what we've been doing here, where we've had perhaps more disappointing holdings, we've really kicked the tires, and where we have felt confident about retaining the investment thesis and confident about augmenting their position in the portfolio, we have done so. But we have also taken some tougher decisions to exit names where we didn't have that confidence or where the competition for capital was much higher. So we have exited the likes of National Express, now called Mobico, where we were concerned about the lack of strength of balance sheet and some operational challenges that they had. We've exited Tesco, where we felt that the investment case had played out and where the future was really still quite competitive within that set, and there was a lot of scrutiny over the level of profitability and a lot of expectation that they would look after their workforces with the always increasing national minimum wage. And we found some new companies that we've wanted to invest in, whether that is Diageo, the global spirits business, which had derated over the 3 years, again, finding some challenges coming out of the COVID period where people had restocked their drinks cabinet, to also companies such as Cranswick, which makes the McDonald's crispy chicken filling to that sandwich and has a fantastic opportunity within the UK food manufacturing sector. I'm sure, again, we'll come back to some of these names just to whet your appetite for Q&A. And moving on to where we can find opportunities amongst the uncertainties that remain at an economic level, and give you a flavour of the sorts of areas that we're looking across the UK equity market. You can see a number of names within resilient franchises. We have a couple of turnaround situations under new management where I feel really very excited and confident about the positions that both Convatec in medtech and Pearson in global education and workforce skills have managed to get themselves to. We've had a number of stocks that we feel have been able to weather the inflation storm, and the big picture infrastructure and energy transition themes. There are a number of UK names that are in the portfolio that we believe are exciting in terms of the future that they can deliver, both for shareholders, but also for the economy and for society. I wanted to just quantify the extent to which we are overweight mid and small sized companies. It's about 10% more or less in terms of active weights. Large cap are nearly 85% of the index. We're around 75% of that in terms of round numbers, and about 25% of the portfolio is exposed to small and mid-cap stocks. I'll give you a sense of what those small and mid-cap stocks can do in a moment, but just to let you know on the next page 24, what kind of questions I've got exercising my mind, hopefully not keeping me up too late at night, but there are a lot of things going on that one has to take account of. I've put inflation at the centre. It's really important for this trust, but I think it's essential for direction of markets. The waning of inflationary pressures through 2023 did help global equities manage to stage quite a sharp recovery from their difficult 2022. And I think the UK in the second half of 2023 showed that it wasn't a complete outlier. There's still some angst about inflation. I think in the UK we're likely to see prints of close to 2% in the next few months, and that should lead central banks, not just in the UK but globally, to start that reduction in interest rate tightening that had been put in place through the latter stages of 21, certainly through 2022 and 23 to 15 to 20-year highs. And that should underpin both the economics but also valuations for markets. It certainly seems to be giving a bit more appetite to M&A, and I'm sure we'll come on to that. But let's just look at what the opportunity is in terms of valuations across equity markets. Here we're looking at data over the last 20 years. It's called a box and whisker chart, and the UK is on the right-hand most end. The blue box shows the 10th to 90th, the interquartile range, sorry, and the whisker, so the line, the 10th to the 90th percentile, and the orange diamond, which I think of as the nose of the cat that's got displaced, is right at the end of the whisker for the United Kingdom, below 10 times on a forward PE ratio. And that's by far and away the cheapest market in international large market environments. If we were looking at this chart some 18 months ago, Japan would have joined the UK with the cat's nose being at the end of the whisker. And what's happened over the last 18 months or so, we've seen much more buoyant stock market performance in response to a lot of initiatives from that government and international investors looking to Japan, having feared China. So assets have moved out of China into other areas within the region, and Japan's been a big beneficiary of that. If we compare on a sector basis, because the pushback I get from a lot of my clients is, well, of course, the UK is a Jurassic Park of industries. And if we look at a sector by sector comparison of the UK equity market against their US equivalents, we can see very substantial discounts for sectors in the UK compared to their US peers. And this is somewhat surprising given how international the UK equity market is. So within this, we have transport, we've got materials and energy and healthcare and food and beverage in probably 30 to 40% discounts. So I think this is a real opportunity, and particularly when you've got sterling having been weak on a multi-year view, I think this is really drawing international investors from a corporate point of view to take advantage of bargains of UK companies. If we have a look at the next couple of slides, this really underpins why I'm so positive on the opportunity in mid-caps. The mid-250 companies are quite often talked about as the Heineken index that refreshes. And what you can see is that over the last 25 years, the FTSE 250 has outpaced even the S&P 500. So this is definitely not the Jurassic Park of markets. And the exciting aspect is really shown on page 28, which is, yes, mid-caps have outpaced large caps over the long term, over that 25-year period. But in the last 3 years, they've suffered significant underperformance, some 30%. So I think that creates a fantastic opportunity today to get in at a discount. And if we have a look at the final page before we summarize, page 29, for me as an income investor for this trust that's looking for both income opportunities and capital opportunities, I'm being given a fantastic opportunity today to buy into the mid-cap, which has historically delivered those fantastic total returns, but not giving up an income yield. So today we're having more or less equal yields from mid-sized companies compared to large-sized companies at a time that I don't see the same levels of distress as we've had historically when this has been the case. We're not in the same problems as the global financial crisis. We're not in the same bubble territory in the UK as we were in the dot-com bubble burst. And we're not in the same political morass as the ERM crisis of 1992. So for all those reasons, Joe, on page 30, I would say there are a lot of reasons to consider UK equities for your ISA in 2024.
Fantastic, Sue. Thank you very much for going through that. That was a very comprehensive update on the trust. We've got a fair few questions, unsurprisingly, that have come through, so we can get stuck into those. I think really sticking on house valuation and on the opportunities that you're seeing, Can we delve into that a little bit more, kind of across the market cap spectrum? Where are you finding the most exciting opportunities? Are there areas that are significantly undervalued? Are there areas you're finding that are fairly valued? And perhaps a couple of examples for our listeners would be great.
Yeah, that's a really good point. I think if we go back to the activity slide, that gives a sense of what we've been doing across. Yeah. So some areas, such as Inchcape, had its results on, well, this week, and they were in the office yesterday. I was out of the office yesterday seeing another client, but it's trading on 7 times with a yield of close to 5. It did a big acquisition of a business in Latin America, and although Latin America has had some economic wobbles, it's still delivering really well. And I just think it's the wrong price. I think you will get good growth. I think it can re-rate to at least a double-digit P. So I can probably see a 50% upside within a 2-year time frame, and I think that's pretty exciting. I talked a little bit about turnarounds, and in medtech, we've got a turnaround that's really gaining traction in Convatec. I felt that Smith and Nephew is another global player that trades on a significant discount to its international peers. I saw the new management, I think it was last Friday, post their results, and I thought came across really well. He's kept the 12-point plan and the targets that he inherited. I think that's good to keep feet to the fire. There are good levels of investment going into that business. I think they have a clearer pathway to delivery. It's always been a potential takeout candidate. I think that's the backstop if it doesn't deliver, or if the shares don't reflect the operational improvements that I think they can put through. Cranswick is a fantastic company. It's what we would call a multi-bagger. So it's increased its total return many times for shareholders over whether you take a 10-year view or a 30-year view. And it doesn't sound very exciting. Poultry and pork and premiumized sausages, bacon, but actually what it does really well. Why it hasn't been in portfolios over the longer term is that it always looked to be fairly or more expensively priced. And it derated along with that general derating of mid and small sized companies over the 3 years that we talked at the end of our slides. Cranswick was one of those. It's not a company that's had a misstep. It's continued to invest in its business. It has really exciting potential. It's getting into pet food with pets at home as well. And it was just its shares hadn't kept pace with the growth. And so it gave me a fantastic opportunity to build a position in a company that had been on my watch list for some time. And I put Diageo into that camp as well, and pensions and consultancy for XPS as well. So I've had to take some tough decisions to sell out of companies that I've quite liked within the portfolio because I want the fund to remain focused. Rio Tinto has gone. Tesco, I've talked about. Spectris is a mid-cap engineer that's doing the right things, but it had performed okay, and I could just see better upside elsewhere.
Brilliant. No, that's very, very clear and quite interesting, actually. And I think keeping along a similar vein, I know we've spoken about this in the past, Sue, but your overseas exposure as you highlighted on the first slide, is nil. It would be great if you could talk us through that, because there is such a plethora of opportunities in the UK at the moment. But there will be some people that argue overseas provides exposure to things that the UK can't quite compete with. So go through your kind of rationale on that. That would be really useful.
I keep an open mind as to being able to invest overseas, and I have for the portfolio in the past. But in today's market, I see a standout opportunity. And I think it's important for listeners to appreciate how international the UK equity market is, which is quite different to a number of other equity markets. So, at a revenue level, UK equities are about 75% exposed to revenues derived from outside the UK. So, when you buy a UK equity product or invest across the market, quite often you are getting international exposure, but you're getting it at a discount valuation. And then within a trust structure that sits at a discount, you're getting an additional discount. So that's why I think there are standout opportunities. I think also from an income perspective, the UK really does punch above its weight. And I think there are a lot of reasons to be positive that would be very difficult to take a chunk of the portfolio to invest in a lower yielding market that's higher priced, when I've got so many opportunities on my doorstep at home.
Fantastic. And yeah, no, that's very clear and makes a lot of sense. And I think, from an outlook perspective as well, the UK has garnered quite a lot of negative sentiment over the years. And as you alluded to at the beginning, to the announcement of the budget this week, perhaps is the beginning of that sentiment starting to change slightly, particularly in the light of the British ISA, which they announced they would be introducing. So it would be really useful for us if you could kind of give us your broader thoughts on the British ISA, and perhaps what this means for the UK, but also what you think it will do to the trust, if it will have any impact at all to the trust.
A great kind of 3-point question there, Joe. If I start at the kind of what are authorities trying to do? There is now, a bit like an alcoholic, there's a recognition of the problem. So, here we are, I'm a UK equity manager. The authorities are recognizing that capital markets are important to be vibrant. They're important for economic growth. They're important for employment and standing. And we lose all of that at our peril. So there has been a range of measures, whether we're talking about Mansion House speeches, about Solvency II for life companies investing in more risk assets, whether it's leveling the playing field in terms of listing rules for companies so that we're not at a disadvantage compared to our international peers. All of that is good. And I see the British ISA creation as an opportunity to get savings and investment back onto the discussion topic. So the government has an ambition to sell down its stake in NatWest. I don't know whether the timing of the British ISA is going to correspond to that. There is a consultation period. There's going to be lots of debate about how do we keep things simple, how do we not complicate it in terms of anything rebalancing. I just think a broad definition of what a UK equity is, and including investment companies, would be fantastic. And a trust such as this would play fantastically into that. Now, not everyone uses their existing £20,000 allowance, but we don't know what is likely to come down the tracks in terms of any other savings, freedoms or restrictions. So I think grab it while you can, making a noise about it, lots of other countries provide tax incentives to invest in their domestic markets. The US, Canada, Singapore, France, lots. And I think we should be part of that party too.
Fantastic. And yeah, I think it's a positive topic. It's going to, I think, create a lot of interesting dialogue. But like you've alluded to there, so we need to wait for the finer details, I think, before to understand the full measures of it. I think it will be. We've got a few questions coming through around the kind of M&A point that you made earlier, and whether that has been a feature and whether that will continue to be a feature for 2024. So if you could give us a bit of a run through of that, that'd be great. I know you mentioned earlier it was the kind of small and mid-size opportunities, but also kind of from the private and the international side as well.
Yeah. M&A, I think, is going to be an ongoing feature until the market re-rates. The things that can re-rate a market, people always ask for catalysts, and it is the fact that external people see value in companies, in shares. They can generate some synergy benefits as well. We're getting both the private equity and overseas corporates buying to accelerate what would be R&D or CapEx. We're seeing some in-market consolidation to get bigger, to improve liquidity across some sectors. So within the paper capital. So, for example, we hold Hollywood Bowl within the portfolio, and that's been a really strong performer over the last 6 months or so. Its peer, 10 Entertainment Group, also a 10-pin bowling company, got acquired. There was no knee-jerk reaction to re-rate the Hollywood Bowl as a consequence of that, and that seemed wrong. It's a high-quality company, preeminent in the UK, with growth opportunities across Canada. But actually, since the proceeds have come through, some 10 Entertainment Group holders have recycled clearly their capital into Hollywood Bowl. It's gone into the FTSE 250. It gives it more credibility and more visibility. They hosted an investor tour earlier this week, actually, in the Midlands, which people were quite excited by, showing that it's bowling, it's the food and beverage offer, which is great value for money, and also the entertainment and amusements offer that you get. So there are lots of different ways of doing that attraction and underpinning what the prospects are.
Brilliant, thank you, Sue. I appreciate we are running slightly over here, but I think one more question to throw your way, as we've had a few come through around discounts. So I think we'll kind of combine them and throw another kind of 2-3 pointer at you. But the discount is currently wide relative to peers, probably slightly wider than its 5-year average. Your thoughts on that, and perhaps what you see in the market that perhaps will reverse that trend and cause the discount to narrow moving forward?
All really good questions. I think for me as a fund manager, what I can do with addressing the discount is to talk about the attractions of the trust and to deliver good performance and to do what it says on the tin. So that's my objective, and that's why I'm here, and that's what motivates me. I'm a big shareholder as well, so I'm really motivated to get that discount to close, as well as the underlying performance to improve. And I think being focused on a really attractive market segment, to be overweight really compelling opportunities. I see it as a once or twice in a career opportunity in that mid space. The other aspect is what the board can do. So the board have the ability to think about and going into the market to narrow that discount through discount control mechanisms. It's something that they keep under active review. Our longer term discount to NAV has actually been quite narrow compared to the sector. It's been a recent phenomenon. And I think the board are really scratching their heads as to, is this something that's going to endure more specifically? So we saw a widening of the discount, particularly in the second half of 2023, and then a bit of a narrowing and then a blowing out as well. I think they are really actively thinking about what they want to do. I can't prejudge what they're going to do. We had a board meeting about a month, two or 3 weeks ago, and it was actively debated. I don't know anything more than the market about what they could or should do, but it's at a point where it's under active consideration.
Fantastic. Thank you for that, Sue. And I think that's a really lovely place to wrap up. I think for those listeners that are still on the webinar with us, apologies for running over. But if you do want any further information on Schroder Income Growth, Sue and the team have got a lot of quality information on the website to go over and check that out. We at Kepler also recently published a note in January detailing more on the Schroder Income Growth Trust, so go and look that out as well. But Sue, it's been a really, really good update, I think, a comprehensive update and really interesting takes on kind of where you see the UK market going. So a big, big thank you to you on that. It's been a pleasure to have you on. And I also want to extend, obviously, our thanks to those who've listened in this afternoon, and hope that you have a great weekend when it comes. I think next week we'll be hosting our second round of sessions for your themes for your ISA event 2024, Give Me Shelter. So we'll see you then. Thanks a lot.